Welcome back to the Deep Dive. Today, wow, we are tackling probably the most talked about, most polarizing, maybe the most confusing asset out there right now, Bitcoin. I mean, seriously, you open any financial news source and it's like whiplash. 1 minute, it's hailed as, the future, digital gold, the ultimate shield against inflation. And then the next minute, you've got these huge traditional finance names calling it the biggest bubble since, was it the 17th century tulip mania? Just pure hype, basically, based on someone else being foolish enough to buy it later. For anyone trying to figure this out, whether you're investing or just trying to stay informed, it's a lot. These price swings are wild, up 20 times and crashing 80%. It's dizzying.
Absolutely. And that's precisely our mission today, to try and cut through some of that noise. We've pulled together a pretty wide range of sources. We've got the crypto native stuff, the deep data dives from places like Glassnode, Cointelegraph, but we've also got the big institutional reports, the skeptical takes from Bank of America, JP Morgan, which you really can't ignore anymore. Look, we're not crystal ball gazing here. We're not trying to predict the next price target. Our goal is more foundational. We want to lay out some clear, objective criteria for what actually makes something a financial bubble, a real one that's doomed to pop. Then we'll weigh the evidence for and against Bitcoin using those criteria. The idea is to give you, the listener, a framework, something to help you sort the genuine signals of adoption from just, the short-term speculative frenzy.
Yeah, exactly. You need to understand the mechanics, the risks involved. So the next time you see some crazy headline, you can actually place it in context. Is this real institutional movement, or is it just another wave of retail hype? Actionable knowledge, that's the aim. Couldn't agree more. And hey, before we really dive headfirst into this whole bubble or future of money debate, just a quick reminder, if you find this helpful, please do like, subscribe, and hit that notification bell. It just genuinely makes a huge difference. Telling the platform you're engaged helps us grow, it boosts visibility, and frankly, it lets us keep digging into these crypto trends and bringing you this kind of analysis. So thanks for that. Okay, let's get into it. Defining a financial bubble. Where do we even start to build a solid working definition based on history?
Right. So drawing from those traditional finance analyses in our sources, we need to establish what a classic bubble looks like. It's not just prices going up fast. It's about three core elements: structural weaknesses that almost guarantee it ends badly. First, you've got that really rapid, almost vertical price surge. It's driven mostly by speculation, right? Not by any real increase in the thing's usefulness or the money it makes. The price just completely disconnects from any fundamental or intrinsic value. Second, that leads to valuations that are just unsustainable. People are basically buying because they believe prices will keep going up forever, justifying today's crazy price. That's the heart of that greater fool theory you mentioned, always someone dumber to sell to. And third, this is the critical part. The asset itself has some kind of fatal flaw built in. Maybe its supply is infinite or can be easily increased. Maybe it has no real productive use. Or maybe there's just way too much borrowing, too much leverage involved. Whatever it is, this flaw ensures that when sentiment shifts, the crash isn't just a correction, it's catastrophic, often permanent.
Okay, that framework makes sense. And those historical examples you brought up, they really hammer home what happens when those flaws exist. Tulip mania, 17th century Holland. It sounds absurd now, right? But people were trading single tulip bulbs, the fancy ones like Semper Augustus, for the price of houses in Amsterdam. It wasn't just a bit of speculation. It was pure irrational madness over something that, well, it just sits there and looks pretty. It produced nothing. No dividends, no industrial use. And crucially, it was a plant. You could grow more tulips. So when the buying frenzy stopped, the price didn't just dip, it collapsed. Utterly. Back to the value of a flower bulb. Because there was no demand outside of that speculative gain that's a pure bubble. Zero utility.
Exactly. Now, fast forward a few hundred years to the dot-com bubble, late 90s. This one's a bit different and maybe more relevant because the underlying tech, the internet itself, was absolutely revolutionary, no question. The valuations, they were detached from reality. Companies with the bond.com after their name were getting billion-dollar market caps with no revenue, sometimes not even a product. The bubble was the belief that any internet company was gold. When that bubble burst, the market crashed hard. Hundreds of companies vanished. But here's the key difference. The underlying technology didn't vanish. The strong companies, the Amazons, the Googles, they survived. They got stronger. The speculative excess died, not the fundamental innovation.
That's a crucial distinction. And the third example, the 2008 housing crisis. That one showed the danger of leverage, right? It wasn't just that house prices were too high, though they were inflated. The real problem was the complex financial stuff built on top these mortgage-backed securities, full of dodgy subprime loans. When those loans started failing, the whole system froze. It wasn't just about house prices. It was about the risk spreading everywhere through leverage.
Precisely. So the pattern is clear. Lack of real utility, supply that can be easily increased, or dangerous levels of leverage. Now, when analysts compare Bitcoin to these historical bubbles, the critical question we have to ask, based on our sources, is this. Is the comparison fair? Is it just based on Bitcoin's crazy price swings? Or does Bitcoin actually share one of these fundamental fatal flaws? Does it have infinite supply like fiat currency? Or zero long-term use like a speculative tulip?
And that's the core tension, isn't it? That structural difference. But hold that thought. Before we dig into the fundamental arguments against it being a bubble, we absolutely have to stare the volatility right in the face. Because let's be honest, that's what screams bubble to most people. The price charts are just wild, especially for traditional investors used to, maybe 5–10% moves in a year. Think about 2017. Bitcoin starts the year under $1,000. By December, it touches nearly $20,000. A 20x return in less than a year. I mean, how can that not look like a bubble?
It absolutely looked like one. And the aftermath seemed to confirm every skeptic's worst fears. From that $20,000 peak in December 2017, it didn't just correct, it plunged. Over the next year, it fell all the way down to around $3,000. We're talking an 85% drawdown. In traditional markets, that's not a pullback, that's a catastrophe. It wipes people out. So yeah, this kind of violent cycle makes it incredibly easy for critics to just dismiss the whole thing as a speculative mania, arguing anything this volatile is fundamentally broken.
And it wasn't a one-off, was it? The next big cycle, leading up to the 2021 peak, was arguably even crazier in terms of dollar amounts. Bitcoin runs all the way up to about $69,000. Now, okay, that time the narrative was a bit different. There was definitely some early institutional money coming in, which we'll get to. But the end result, same story, different numbers. Another massive, painful crash followed.
Exactly right. From that 69K peak, we saw huge drawdowns again. Depending on how you measure, 70% or even more. The price got pushed all the way back down towards the $16,000 level over the following year or so. It's these repeated, incredibly sharp boom and bust cycles that provide the ammunition for the bubble argument. The critics look at the speed and the sheer depth of the crashes and say, see, the price was never real. It was just air.
Which naturally leads us to the whole social aspect, the psychology behind these peaks and troughs. Our sources definitely highlight that get-rich-quick mentality. It feels like classic retail mania sometimes.
Oh, absolutely. It taps right into basic human psychology, this idea of extrapolative expectations, the belief that recent trends will just continue indefinitely. People see the price rocketing and they jump in, not necessarily because they've read the white paper or understand the halving cycles, but because they think, hey, I can buy this today and sell it for more next week to some other guy. That's the greater fool theory in action.
And the media plays a huge role, amplifying everything. As the price climbs, you get wall-to-wall coverage, non-stop positivity. This fuels that fear of missing out FOMO. People who really shouldn't be anywhere near such a volatile asset feel compelled to buy, often right near the top.
And then what happens when it turns? The same media outlets often pivot instantly to panic mode. Headlines scream about the crash. That just accelerates the sell-off, scares the latecomers into selling at a loss, and reinforces the whole bubble narrative for everyone watching from the sidelines. It doesn't matter at that point what the underlying tech or scarcity arguments are. The appearance is pure chaos.
Right. This whole roller coaster of euphoria then despair, it forces the big question we want you, the listener, to grapple with. When you look at Bitcoin right now, wherever the price happens to be, do you see an asset trapped in another speculative bubble doomed to crash again? Or is it just going through another one of its characteristic, albeit brutal, cycles before potentially heading towards a new high? Because figuring out whether it's a bubble or a cycle, that hinges entirely on the fundamental arguments we need to unpack next.
Okay, so let's shift gears. Let's look at the evidence, the arguments that strongly suggest Bitcoin doesn't actually fit that classic definition of a doomed financial bubble. This is the fundamental case. And the absolute starting point, the biggest structural difference that sets Bitcoin apart from, say, tulips or fiat currency or even those dot-com stocks with no revenue. It's the supply, the hard cap. This is really the bedrock of the whole digital gold idea. Bitcoin's code dictates that there will only ever be 21 million BTC, period. That number cannot be changed by any government, any central bank printing press, or any group of miners deciding they want more. It's immutable.
And that point alone fundamentally breaks the comparison with most historical bubbles, doesn't it? Like you said, the Dutch government could have encouraged more tulip growing if they'd wanted to. Governments print money all the time. That's monetary policy. You can build more houses. But you can't just make more Bitcoin beyond that 21 million limit. Its scarcity isn't decreed by a government. It's enforced by math, by the code itself. And that's where the digital gold analogy really gains traction. Gold is valuable largely because it's scarce and hard to get out of the ground. Bitcoin shares that scarcity digitally.
Precisely. So the debate immediately shifts.
Mhm.
It stops being about, can this thing be infinitely copied or printed into oblivion? Because the answer is clearly no. The debate becomes, okay, it's scarce, but does this scarce digital thing actually have any utility that justifies people wanting to own it and giving it a market value?
Mhm.
And increasingly, the answer to that utility question seems to be coming from some of the biggest financial players on the planet. Which brings us to institutional adoption.
This is a huge piece of the puzzle. The idea that Bitcoin is just for, cypherpunks or retail gamblers. That narrative really starts to fall apart when you see the names getting involved. We're talking BlackRock, Fidelity, even companies like Tesla, MicroStrategy, putting it on their balance sheets. I mean, think about BlackRock. They manage trillions of dollars. When a behemoth like that spends serious time and effort lobbying regulators and then successfully launches spot Bitcoin ETFs, that's not a trivial move. They're essentially building a bridge. They're creating regulated, familiar ways for huge pools of capital pension funds, endowments, maybe even sovereign wealth funds eventually to get exposure. It's like an institutional seal of approval, reducing the career risk for traditional fund managers to allocate.
And it's crucial to understand why they're doing it, according to the analyses we've seen. It seems to be driven by a couple of things. One is simply client demand. Their customers are asking for Bitcoin exposure. They want an asset that doesn't always move in lockstep with stocks and bonds. But maybe more importantly, there's a growing recognition, even within these traditional institutions, of Bitcoin's potential role as a hedge against inflation, as a store of value in an era of, frankly, unprecedented money printing by central banks.
Look at MicroStrategy. Their strategy is probably the boldest example, deciding to convert large portions of their corporate treasury from cash into Bitcoin. That's a direct rejection of the "it's just speculation" argument.
Exactly. They're explicitly treating Bitcoin as a better long-term reserve asset than holding dollars that lose purchasing power year after year due to inflation. That's a strategic balance sheet decision aimed at preserving value over the long haul. It's not about flipping it next quarter.
Okay, but let me push back a bit here, play the skeptic for a second. This is an argument you sometimes hear, maybe reflected in those more cautious reports from places like JP Morgan. Isn't this institutional involvement just fancier packaging? Are they just creating easier ways for big money to play the same volatile game, maybe even capitalize on the retail swings? Couldn't it just mean the bubble now has Wall Street's stamp on it, making it potentially even bigger and more dangerous?
That's a fair and necessary challenge. The sources that argue against the bubble narrative tend to address this by focusing on the nature of the institutional involvement. It's not just hedge funds trading futures anymore. The move towards regulated spot ETFs, the intense scrutiny from regulators like the SEC that goes into approving these products, the development of sophisticated custody solutions by players like Fidelity. This all points towards a longer-term commitment. Building this kind of robust, regulated infrastructure suggests they see lasting value and utility, not just a fleeting trading opportunity. You don't typically invest billions in building plumbing for an asset you think is fundamentally worthless and heading to zero. It signals a belief in its potential staying power and integration into the financial system.
Right, that makes sense. The infrastructure argument is compelling. And this ties directly into the broader macroeconomic case for Bitcoin, doesn't it? Using it as a real economic tool, especially against inflation or currency devaluation.
Yes. Because Bitcoin's supply issuance is fixed, predictable, and completely outside the control of any government or central bank, it holds a unique appeal. Especially for people, and maybe even businesses, looking for an asset that can't be debased by political decisions or endless quantitative easing. In times of economic uncertainty, high inflation globally, or geopolitical tension, that predictable scarcity can make Bitcoin look like a potential safe haven, an alternative way to store value.
And we actually have a fascinating real-world test case for this, right?
Yeah.
El Salvador.
Exactly. El Salvador's decision to adopt Bitcoin as legal tender and hold it in its national reserves. I mean, talk about putting your money where your mouth is. This isn't just theory anymore. It's a country-level experiment happening right now. Bitcoin is being used, or at least tested, for everyday things like sending money home from abroad, remittances, for small business payments, and as part of the nation's strategic reserves. Now, obviously, it's a hugely controversial move, incredibly risky for them. But the very fact that a nation, particularly one facing economic challenges, sees Bitcoin as a potential solution, as a functional monetary tool, that directly contradicts the idea that it's just a useless speculative token like a digital tulip. It shows some people see real-world utility there.
Okay, so we've got the scarcity argument, lock supply. We've got growing institutional adoption and infrastructure build-out. We see potential macro use cases being tested. But let's dig deeper into the structure. What drives the long-term value beyond just scarcity? How does the network itself contribute?
This brings us to the concept of the network effect. It's a fundamental principle. The value of a network increases exponentially as more users connect to it. Think about the early internet or social media platforms. Bitcoin's value proposition grows similarly. More users mean more people to transact with. More transactions potentially mean more utility. More adoption attracts more miners, which makes the network more secure. So we look at things like, is the number of unique Bitcoin wallets growing over time? Is the volume of transactions increasing? Is the network's hash rate, a measure of its computing power and security, going up? These are indicators of the network's health and growth. A growing, increasingly secure network becomes harder and more expensive to attack or disrupt. This creates a positive feedback loop. More security builds more trust, which encourages more adoption, which further strengthens the network. This inherent growth dynamic is something purely speculative bubbles lack. They don't usually get stronger as more people pile in. They often become more fragile.
Okay, this is where we need to, as you said, put on our analyst hats and really get into the weeds with some of the on-chain data. Sources like Glassnode provide this amazing window into what's actually happening on the Bitcoin blockchain, beneath the surface of just the price. It tells us what investors are doing, not just saying. Let's start with one of the most compelling metrics. HODL waves. Sounds like a crypto meme, but it's actually very insightful. Can you break down what HODL waves show us and why they matter for assessing stability?
Sure. HODL, of course, comes from that famous forum typo for hold, and it signifies a long-term investment mindset. HODL waves visually represent the age distribution of the Bitcoin supply. They basically track every Bitcoin, or fraction of one, and show how long it's been sitting in its current wallet without moving. So you can see what percentage of the total Bitcoin supply hasn't moved in, say, the last 24 hours, the last week, month, 6 months, year, 3 years, 5 years, even longer. Now, if Bitcoin were just a short-term speculative bubble, what would you expect to see? You'd expect most of the coins to be constantly changing hands, held by short-term traders trying to catch the next wave. The HODL waves would be dominated by young coins.
But that's not what the data generally shows, is it?
Not consistently, no. What Glassnode and others often highlight is that a very significant portion of the Bitcoin supply, often upwards of 60%, sometimes even higher during certain market phases, is held by addresses that haven't touched their coins in over a year, or even over 5 years. These are the long-term holders, the veteran hands.
And what does that imply about the market's nature if so many coins aren't moving?
It signals a couple of crucial things. First, market maturity. It suggests a growing base of investors who aren't just trading the volatility, but see Bitcoin as a long-term store of value, maybe like that digital gold. They're relatively insensitive to short-term price swings. Second, it impacts the actual available supply. If 60–70% of Bitcoin hasn't moved in years, it means the liquid supply, the coins readily available on exchanges to be bought or sold, is much smaller than the total 21 million cap implies. This cohort of long-term holders acts like a sponge, absorbing supply during dips and reducing selling pressure. Their conviction provides a kind of underlying stability, even amidst surface volatility. It shows a shift from a market of tourists to a market with long-term residents.
That's a really powerful insight. Okay, next metric, the amount of Bitcoin being held on exchanges. Why is tracking that important?
Right, so tracking the balance of BTC sitting on major exchanges like Binance, Coinbase, Kraken, etc., gives us another angle on potential selling pressure.
Generally speaking, when investors move their Bitcoin onto an exchange, it often signals an intention to sell, or at least have it ready to sell quickly if the price moves favorably. It's making the asset liquid.
Conversely, when we see a sustained trend of Bitcoin leaving exchanges, it usually means investors are withdrawing it to cold storage. That means moving it offline, typically to secure hardware wallets that they control directly.
And why would they do that? What does that signal?
It's a strong signal of accumulation and long-term conviction. Taking self-custody is a deliberate action. It means you're prioritizing long-term security over short-term trading flexibility. You're essentially locking those coins away, indicating you have no plans to sell them anytime soon. So if you see exchange balances consistently falling over weeks or months, especially during price consolidation or dips, it's interpreted as strong evidence that investors are accumulating for the long haul, reducing the immediately available supply and potentially setting the stage for future price appreciation if demand increases.
Got it. Accumulation into cold storage. What are the big players? The whales. Can on-chain data tell us anything about what they're doing?
Yes, analysts spend a lot of time tracking the activity of wallets holding large amounts of Bitcoin, the so-called whales. While it's tricky because one entity can control multiple wallets, you can look at the behavior of large UTXOs, unspent transaction outputs, or clusters of wallets known to belong to large holders. What's particularly interesting is observing their behavior during major market crashes. In traditional market bubbles, the narrative is often that the smart money, the big institutions or informed insiders, get out first, leaving retail holding the bag.
Right. They see the writing on the wall and sell quietly near the top.
With Bitcoin, however, on-chain data often reveals something different during those massive 50–70% drawdowns. We frequently see evidence of whale wallets aggressively accumulating during the panic selling. They seem to view the crash not as the bubble bursting, but as a discount buying opportunity.
So they're buying when retail is panicking.
Often, yes. That pattern suggests that the largest, presumably most sophisticated or deep-pocketed players have strong conviction in Bitcoin's long-term recovery and future value. Their accumulation provides buy-side support during crashes, and again contradicts the idea that it's just a flimsy bubble everyone knows is going to zero.
Okay, let's circle back to that dot-com analogy for a moment.
Yeah.
You mentioned earlier that the crash wiped out the weak companies, but the strong, innovative ones survived. How does that parallel apply here, considering these fundamentals we've discussed?
I think it's a really useful lens. The core insight from the dot-com bust wasn't that the internet was a fad. It was that most early internet companies were poorly run, had no viable business model, and were wildly overvalued based on hype. The survivors, like Amazon or Google, had genuinely revolutionary technology and figured out how to build sustainable value on top of it. So, applying that to Bitcoin. The argument is that the underlying technology, the decentralized ledger, the provable scarcity, the non-sovereign nature, is the fundamental innovation. That's the internet part.
And the price volatility.
The price volatility is the market trying, often painfully and inefficiently, to figure out what this completely new kind of digital commodity, this potential Amazon of money, is actually worth. It's a multi-year, maybe multi-decade process of price discovery. In this view, the volatility isn't the sign of a fatal flaw. It's a symptom of the market grappling with something radically new, something with no historical precedent for valuation. The crashes are washing out the short-term speculators, the weak hands, similar to how the dot-com bust cleared out the unsustainable businesses.
That reframing is interesting. Volatility not as the disease, but as a symptom of price discovery for something fundamentally sound. And there's one more unique structural element of Bitcoin that plays into these cycles, right? The halving.
Absolutely. The halving is key to understanding Bitcoin's somewhat predictable cyclical nature, and it distinguishes it sharply from assets whose supply is elastic or politically controlled.
Can you explain the mechanics again? How does it work and how does it influence price?
Sure. The halving is an event baked right into Bitcoin's code. It happens automatically roughly every 4 years, or technically every 210,000 blocks mined. What it does is cut the reward that miners receive for successfully adding a new block of transactions to the blockchain exactly in half. Miners expend huge amounts of energy and computing power to secure the network and validate transactions. Their reward, paid in newly created Bitcoin, is the primary source of new supply entering the market. So when that reward gets cut in half, the rate at which new Bitcoin is generated also gets cut in half. It's a programmed reduction in the inflation rate of Bitcoin.
So it's a supply shock. Less new Bitcoin hitting the market.
Precisely. A predictable, transparent, periodic supply shock. For instance, the reward started at 50 BTC per block, then half to 25, then 12.5, then 6.25, and most recently in 2024, down to 3.125 BTC per block. This continues until roughly the year 2140, when the last fraction of a Bitcoin is mined.
And the historical charts show a pretty strong correlation between these halving events and subsequent major bull runs, don't they?
The correlation is undeniable, though causation is always debated. Historically, in the 12–18 months following each halving, Bitcoin has experienced a significant price increase, often leading to a new all-time high. The thinking is that this programmed reduction in new supply, happening against a backdrop of potentially stable or increasing demand, creates upward pressure on the price.
Which then attracts more attention, more speculation.
Exactly. The halving acts as a catalyst. The anticipation of the supply shock, often amplified by narratives like the controversial but influential stock-to-flow model, helps kickstart the bull run. Speculative interest builds, FOMO kicks in, the price potentially overshoots, driven by hype.
And then comes the inevitable correction. the bubble-like crash phase.
Right. The market gets overheated, leverage might build up, and eventually it corrects sharply. Then it tends to consolidate and stabilize at a higher low than before the cycle began, eventually setting the stage for the run-up into the next halving. It creates this inherent 4-year cyclical rhythm.
So putting it all together, this is the crucial synthesis for investors, isn't it?
I think so. The key takeaway needs to be nuanced. Based on its core characteristics, finite supply, growing network effect, increasing institutional integration, real-world use cases being tested, Bitcoin does not seem to fit the classic definition of a structurally flawed, doomed financial bubble like tulip mania or worthless dot-com stocks. It has fundamental differences. However, investors absolutely must recognize that Bitcoin exhibits dramatic, recurring, bubble-like price cycles. These cycles are driven by a combination of the halving supply shocks and the resulting waves of hype, speculation, and emotion. So effective risk management in Bitcoin isn't about denying the volatility, it's about understanding its cyclical nature. It's about differentiating the speculative froth around the halving cycle peaks from the underlying slower moving trends in fundamental adoption, like those HODL waves growing, exchange balances falling, and institutional infrastructure being built.
That's a fantastic summary. Structurally sound, perhaps, but prone to these wild speculative episodes. So boiling down our key takeaways, we've got this constant tension. On one side, the powerful narrative of scarcity, of digital gold backed by that hard supply cap. On the other, the undeniable reality of massive volatility that looks and feels like a bubble to many. But the evidence seems to be tilting, doesn't it? Growing institutional buy-in from giants like BlackRock, who are putting serious reputational capital on the line. And that objective on-chain data, the HODL waves showing long-term conviction, the whale accumulation during, dips these point towards a strengthening fundamental base. The fact that the market keeps recovering from these huge drawdowns, combined with that finite supply, really does make it structurally different from historical bubbles that just collapsed and never came back.
Agreed. And that really leads us to the final, perhaps most important question we want to leave you, the listener, with. It's something you have to decide for yourself, and it shapes everything about how you might approach this asset. If you accept the argument that Bitcoin has fundamental strength, that it's not just a bubble waiting to pop definitively, the big question becomes, what's its future trajectory? Do you believe Bitcoin will eventually mature, stabilize, maybe behave more like gold, becoming less volatile over time, acting as that reliable inflation hedge influenced more by broad macroeconomic trends? Or do you think it's destined to remain this highly volatile asset, forever defined by these intense halving-driven boom and bust cycles, making it more of a high-risk, high-reward speculative play, albeit one with unique properties, rather than a stable store of value?
That's the million-dollar question, isn't it? Or maybe the 21 million Bitcoin question.
Indeed. And how you lean on that question of eventual stability versus perpetual volatility really dictates your personal investment horizon, how much you might allocate, and ultimately your tolerance for the inevitable wild ride along the way.
Well, that feels like a good place to wrap up this deep dive. We hope breaking down the bubble arguments, the fundamental counters, the on-chain data, and the cyclical nature has given you a clearer framework for thinking about Bitcoin and cutting through some of that headline noise. Thanks for tuning in. We'll catch you on the next deep dive.